HSBC is a really interesting stock for investors. It's the largest bank in the UK and Europe and one of the world's largest banks, operating in over 60 countries and serving 40 million customers globally. However, it's got a market cap of 120 billion, and over the past 12 months, the stock has surged 37%. So is there still room for growth, or has the opportunity passed? In this video, we'll analyse HSBC's business model, the key growth drivers, and the stock fundamentals, so you can decide whether HSBC is a buy or not in 2025. Let's dive in. HSBC is a very Asia-focused bank. Currently, 50% of the revenue comes from Asia, 35% from Europe, and 15% from North America. This revenue can be further broken down by the three main business segments. Wealth and personal banking generate about 41% of total revenue, commercial banking contributes 35%, and global banking and markets account for around 24%. So HSBC is diversified in its financial services, but is heavily dependent on the Asian markets. So let's look at where the future growth will come from. The first growth area is the doubling down on the expansion in Asia, particularly in Hong Kong, Singapore, mainland China, and India. Hong Kong and Singapore are financial hubs, and mainland China and India are fast-growing consumer economies, home to around 35% of the global population. To capitalise on this growth, HSBC is expanding its wealth management services, targeting high net worth individuals in these areas. Recently, HSBC also acquired AXA Singapore, strengthening its insurance and savings division. HSBC leadership has made it clear that insurance will play a key role in their future strategy, stating that we will see much more of an insurance-led approach to HSBC's growth, bringing in more new-to-bank clients. In Western economies, HSBC is hoping to leverage its size to cross-sell products to existing customers. This means that HSBC wants to be the first port of call for insurance products and will start to break into the markets where companies like Aviva and Legal & General currently have a hold on the market. The second growth area is through digital transformation. And like many banks, HSBC is investing heavily in digital banking to cut costs and improve customer experience through AI-powered financial services, enhanced mobile banking, and automation to improve operational efficiency. And the final growth area for HSBC is through sustainable finance and supporting businesses transitioning to a low-carbon economy. However, I think these are just buzzwords to make HSBC sound good, and while sustainability is important, it's not going to drive significant revenue growth, and definitely not as much as the HSBC expansion in insurance and the Asian markets. So this all sounds great, but no investment is without risk, and HSBC's Asia-first strategy is no exception. While expanding in Asia presents massive growth potential, it also comes with significant challenges. First, there's HSBC's heavy reliance on China. The bank generates a large portion of its revenue from the Chinese market, making it highly exposed to any economic slowdowns, regulatory crackdowns, or geopolitical tensions in the region. If China's economy weakens or faces stricter financial regulations, HSBC's profitability could take a serious hit. HSBC has also been retreating from Western markets, and in recent years the bank has exited investment banking operations in Europe and the US, choosing to focus more on Asia. While this shift does allow HSBC to concentrate on high growth areas, it also means losing influence in key Western financial markets, and this could make HSBC more vulnerable if Asian markets experience volatility. And finally, there's the issue of HSBC's bureaucratic culture. Former employees and analysts have criticised the bank for being slow to make decisions and adapt to changing financial trends. In a highly competitive banking landscape, agility is crucial, and HSBC's rigid corporate structure could be a limiting factor when trying to seize new growth opportunities. So while HSBC's expansion in Asia looks promising, these risks should not be overlooked. So let's take a look at HSBC's stock fundamentals and see if the numbers support a strong investment case. Looking at valuation metrics, HSBC is trading at a PE ratio of approximately 7.2, which is notably lower than the industry average of 8.5. This lower PE ratio suggests that investors may perceive HSBC as undervalued compared to its peers. The price to book ratio stands at 0.95, which is below the typical benchmark of 1. A PB ratio under 1 can indicate that the stock is trading for less than the value of its assets, potentially signalling an undervalued condition. However, these promising metrics do change when we start to look at the growth metrics. HSBC's PEG ratio is approximately 1.12. The PEG ratio provides insight into the trade-off between a company's price, earnings, and expected growth rate, and a PEG ratio above 1 is generally considered a bit overvalued. Additionally, the price, earnings to growth and dividend yield, also called the PEGY ratio, is about 1.35. This metric adjusts the PEG ratio by incorporating the dividend yield, offering a more comprehensive view of valuation, especially for dividend-focused investors. A PEGY ratio above 1 does indicate that the stock may be overvalued relative to its growth and dividend prospects. However, HSBC does have an amazing financial performance. It reported a net revenue of approximately $66 billion and a net income of around $22.6 billion, resulting in a net profit margin of 38.9%. And these figures reflect a robust profitability profile. The dividend yield is also currently at 5.8% and has shown consistent growth since 2020. Making HSBC attractive for income-focused investors. On the balance sheet, HSBC's total assets significantly exceed its total liabilities, with total cash holdings of about $1.1 trillion. This substantial cash position not only underscores the bank's liquidity strength, but also ensures that its dividend payouts are well covered. So this stock is one that I will be adding to my portfolio in just small amounts to build out the dividend side of my portfolio. Did you enjoy this video? If you did, let me know in the comments, and if you want me to analyse any other stocks, then just let me know as well. Thank you very much for watching this video, and if you enjoyed it, please remember to like, comment and subscribe. See you soon.